we were talking about how China seems serious about cracking down debt as well as carbon use right now. But the question is, at what cost? Do you think the cooling Chinese economy, is that now a bigger risk than a Fed tapering, for example?
So certainly, I think we seem to have got past the Fed tapering concerns in recent times. They've brought forward their timelines. They may be even accelerating them, and markets sort of brushed them off. But clearly, what's going on in the Chinese economy is getting much more attention globally at the moment, and undoubtedly we will see a slowdown in the economy as we move into next year. That's pretty much everybody's forecasting that. So that's not surprising. I suppose the question is now to what extent that's going to happen and what are the knock-on implications for global growth. I think our perspective is global growth is still going to be pretty handsome this year and next. But clearly there are slight headwinds coming from China.
Steve, there is that contagion effect. It seems like right now it's contained, but if you take a look at the spillover, whether it's suppliers or construction or some of the other very over-leveraged property developers, there's that sort of contagion effect. Then you have companies that actually have exposure to China as well that are at risk. How do you view the spillover effects right now, and how are correlations looking to you?
So, I mean, from our perspective, anything that extends the global economic recovery by reducing inflationary pressures and allowing the recovery to continue into the longer term is ultimately going to be good for asset markets, right? And obviously, risk assets in particular, such as equities. So from that perspective, you could argue that this isn't necessarily that bad a thing, especially when the West is growing very, very strongly. So, and inflationary pressures have risen, at least in a transitory manner. So from that perspective, you could actually see this as a positive. Markets, obviously, we're seeing a little bit of volatility coming through last week, but still overall, actually, equity markets have been holding up pretty well. So our bias is still to favor Europe. Obviously, that does have an exposure to Asia and China specifically. But the election results there, the fact that 10-year bond yields are going higher, supporting value, to our mind, suggests that European equities will outperform going forward.
Yeah, I was going to ask you about just DM overall. I mean, we have a lot of Fed speak this week. We're already seen the U.S. 10-year hit around 140, 143. I'm just wondering, how volatile do you think bond markets are going to be this week?
It looks like it could be a little bit more volatile than maybe we would have even discussed 48 hours ago. We've seen a firm base, it seems, in the 10-year yield being formed here. And the environment suggests that maybe we could see bond yields move a little bit higher. I think, from our perspective, how will growth stocks digest that is a key question. Clearly, when we saw a spike earlier in the year, we saw growth getting hit, but value doing well. Value does seem to be forming a base here. So I was looking at the value chart this morning. We seem to have formed a firm base now and starting to move higher. We haven't broken out of the recent range, of course. So that's still a question as to when and if that will happen. But our view is that we should be buying value on dips and looking for an ultimate break to new highs this year.
Steve, with some breaking news here, the PBOC injecting a net 100 billion renminbi in open market operations. This is, I think, the 6th day now we have seen these liquidity injections from the central bank as they try to ring fence the Evergrande situation. We're also nearing to the quarter end, the seasonal factors here and the cash demand that we see when it comes to renminbi. I'm just wondering, is this going to be enough, these liquidity injections, as a signal from Beijing that they essentially have markets back? And how supportive do you think that is going to be for the market? Or do we still need a triple R cut sometime, somewhere?
Yeah, so obviously we've seen the pivot towards easier policies progressively over the last few months. We expect that trend to continue, and we do look for another triple R cut from the authorities. Now, they will be obviously very concerned about ensuring that we don't see excessive credit creation going forward, because it's a balancing act for them. But given the trajectory of the economy, the fact that we're likely to see a slowdown, and we've got to manage these property sector challenges, we do see further liquidity injections and rate cuts, triple R cuts coming through, and that should turn the corner when it comes to the credit impulse that the authorities are managing. So maybe towards the second quarter of next year, we should see growth stabilize and maybe improve somewhat.
Yeah, it seems like you're still kind of leaning towards DM, though, whether it's U.S. or Euro era equities. Is there any kind of swing factor, you think, Steve, that could bring you back to this part of the world and focus a little bit more on EM in Asia?
Actually, because we prefer to take our China exposure through high yield bonds, actually, because we believe, although obviously there's a lot of uncertainty there, that's largely priced in our view. But when it comes to equities, I think the key thing is going to be what happens to the dollar. The dollar is facing stiff resistance. It's interesting it didn't break higher on Friday when 10-year bond yields went higher. So that's quite an interesting fact. But we really would like to see the dollar break definitively lower. And then, obviously, generally, we become much more bullish on emerging market and Asian assets, including in the equities. But for now, US and Europe is where the money is likely to stay or go to.